Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. Corey and Shad here, your host for this weekend's edition, also your host throughout the week. And one happy thing that I can report from at least my family life is that we did welcome my new son to the world on March 1st. So if you hear any squawking in the background, that just might be him. Very exciting time for our family, and also a very exciting time for all the precious metals bugs that listen to the show, because on that day and the follow through early on in this last week, we have seen precious metals continue to move higher, and a wide range of the stocks get a bounce off some pretty washed out levels. But that gives us a lot to talk about throughout the week and on this weekend show. On this weekend show, we're featuring two of our more generalist commentators, but with a focus on how they're playing the precious metals and a lot of other areas that are at all-time highs. Chatting right now with Mike Larson, editor-in-chief at MoneyShow. Mike, as I said, let's start off with precious metals. Gold breaking two all-time highs in the face of a lot of other sectors at all-time highs. Let's start with gold here. What do you think of this breakout, Mike, and how much higher could gold be going?
Well, geez, I feel like the obvious thing to say first is congratulations to you and your family. Very happy for you. The second thing I was going to say is I guess I pretty much have to credit you for the breakout here, right? I mean, you timed the birth and the gold move here perfectly, so thank you for that, for all the gold bugs out there.
Yeah, hey, my pleasure. We can thank Buster for that, but I'm sure we'll hear from him a little bit later in the show.
No, I'll tell you, I mean, we were joking in previous conversations when I've been on the show that it's sort of been like a waiting for Godot environment. I think, a lot of the ingredients have been coming together, in my opinion, for a bull market in precious metals, whether that's the sideways to down move in the dollar ever since 2022's rip higher, whether it's that the Fed has been pivoting from a tightening stance to a sideways and this year cutting stance, whether it was just investors looking for sort of the next asset that has sat out a bull market and is likely to run. There are a lot of reasons behind why gold and silver and precious metals should have started running, but it was frustrating for a while there. You and I, people on the show, counseled patience, and you know what? Patience is being rewarded. This is the version of waiting for Godot, the play where at the end of it, Godot actually shows up. So that's nice to see. I think what's encouraging in the short term is that we've been banging away at that overhead resistance in the gold market for a while, failed a couple of times, tried to break through, failed, tried to break through again, failed. But the pullbacks were pretty shallow. It wasn't like, gold pulled back $200, $300 after failing to break out. It was more mild. That was an encouraging sign. And now, we're seeing follow through. So a breakout's great, but if it lasts for a day or two, that's not necessarily a confirmed one. But what we're seeing here is not just a breakout that's holding. We're also seeing it extending. So I think that it's encouraging technical action. The fundamentals have been lining up for a while. And I think this move runs. I think this is the start. We've sort of been in that seventh inning stretch of the baseball game for a long time. They kept singing and we didn't get back to play. But now we are. And I think that this move is going to be one of the signature moves that we'll see in 2024.
Well, Mike, you're sticking with that analogy of the seventh inning stretch and everybody singing, we finally get back to the game here. Does that mean that there's only two innings left? And the reason I ask the question that way is there are some people that think we've been running in the gold market sporadically and kind of haphazardly since 2016 when it bottomed, or 2015, the end of the year in December, and that it's essentially doubled, gotten stuck, bumping its head on 2000, finally breaking out. There's other people that think the new secular bull market in gold is just now starting and that it has this long time frame. How are you seeing it in the bigger picture?
Sure. I mean, I started getting bullish on metals. I mean, as Corey said at the beginning, I'm not a gold bug per se. There's times when I like the metal, times when I don't, and times where I'm just looking at other parts of the market for opportunities, but if there's a bull market, I'm going to play it and I'm going to lean in. And I think I kind of looked at the start of this bull market in the second half of 2018. I would probably more appropriately call this maybe the fifth inning stretch that we just got out of, because I think we're probably only about halfway through this move overall. I think, again, and a big part of that is the pivot in the monetary policy backdrop and the currency, and the fact that gold's got some catching up to do. And let's be honest. I mean, a lot of money has been flowing into crypto, Bitcoin, things like that as a result of, the big run there and the fact that the SEC approved those spot ETFs for trading in the US. And that's getting all the press, and rightfully so. It's a big deal. But I think what's really stands out to me is the quiet nature of this gold bull. I don't see news stories all over and everybody yelling from the rooftops, "Hey, look, gold's breaking out," which I think is from a different standpoint, a sentiment standpoint, actually encouraging for the longer term. Everybody wants to talk crypto, and you've seen the big inflows to crypto ETFs, Bitcoin ETFs. You've actually seen outflows from things like GLD, but what's happening? Gold's rallying anyway. So that tells you, the late money, the bullish, extreme bullish retail sentiment, we're nowhere near that in the gold space, which is another thing that I think is encouraging from a, will this move last standpoint.
Let's also talk about GDX and GDXJ, because look, gold has really just been knocking on these all-time highs for almost 4 years now. 2020 was the big run up to almost 2100, then it tested it again in 2022, and then tested in 2023 a couple of times, and now has broken out. The thing is, the gold stocks have continued to sell off. Back in 2020, gold stocks were about almost 50% higher looking at something like GDX than they are now. So how do you understand this lack of correlation here where gold has stayed strong and the stocks have continued to get cheaper?
I think some of it is just, again, your portfolio managers, the modern guys are looking for sort of tech plays and what's going to be hot and how to play the new and exciting thing, crypto and all of its sort of tie-ins, AI and so on. I think part of it has just been, overcoming the narrative. It hasn't been exciting. It hasn't had momentum. It hasn't had, technical strength to correlate. And the underlying commodity has just been moving sideways. I think now, again, that's where you're going to see, I think, in this case, a real powerful move there as people realize, hey, what's happening in some of these more exciting parts of the market are great. But, the fund managers have just been sort of ignoring a sector of the market that hasn't done anything, start having to educate themselves and get interested again, and big money gets involved. So I think that sort of process, once this breakout not only holds but extends, then you're going to see people say, gosh, you have this relatively, in terms of, relative to the overall markets and other sectors that are huge in terms of market cap and market dominance like tech and so on. They're going to say, geez, you got this small corner of the market that's been ignored for so long. If I wait until it becomes popular again, I'm going to miss out on a lot of upside momentum. So I think you're going to see money flowing there. And I think that it's just, it's starting now. And again, as this move confirms and extends and gains a little bit of momentum, then you're going to see people start to pile in.
Well, Mike, since you do follow such a wide swath of markets, I want to pull on the string a little bit further of the cryptocurrency space versus the speculative side of the gold space, which is the mining stocks. We've had some animosity in both camps, where there's people at the precious metals level hurling rocks at the crypto people, and vice versa, the crypto hodlers, calling them boomer rocks back at the gold people. There are people in the middle, though, that are pragmatic and look at them both as very similar markets. But there's been the notion that the crypto space has been stealing that speculative flow of funds from the mining stocks, which maybe would have gone there in years past when the crypto space didn't exist. Can they coexist? Do you think some crypto people will eventually get into the mining stocks, or has the market substantially changed now that the cryptoverse has been created over the last dozen years or so?
Look, I think that the best advice or thing I would say here is, hey, why can't we all get along, right? It's been this market where it's been either or, but I think since we had the huge run up in crypto and the crypto crash a few years ago, and that led to all the fraudsters kind of being flushed out of the system, all the garbage, all the people that were, just sort of hangers on and glomming onto that move and scamming people out of their money. You had the huge boom and run up and crash, and now you're in what I think on the crypto side is a more sustainable, let's look through the survivors, let's see how now this asset's being sort of more institutionalized, how we can profit and so on. So I think that we're probably on the crypto side, I think this is more of a lasting move, whereas I basically sat out most of what we had before because it looked a lot like a dot-com boom and bust, housing boom and bust, and so on. In the wake of both of those busts, what happened? You cleaned out a lot of the garbage, a lot of the lousy home builders went broke, a lot of the money-losing dot-coms went broke, but there ultimately became an industry and an ecosystem and investments that survived that became very profitable for people who got in after the wreck. I think that's probably what you're seeing in crypto. And as for the gold side, it doesn't, to me, it doesn't have to be an either or, especially as it gets more institutionalized. I think you're going to see traditionalists that are still going to stick with gold. It's been there for a couple thousand years, slightly longer history than Bitcoin's been around. So I think that you're going to have the traditionalists. And I think if it gains some momentum, I think what you might actually see, ironically enough, is if, Bitcoin after this run up maybe stalls out after it breaks out to a new high and goes through some of the sideways chop that gold did, some of the momentum players are going to say, well, these are starting to move together, but what hasn't moved up already a lot versus what has moved up already a lot? And so I think you would, ironically enough, you might see some momentum money start to pile into gold if Bitcoin just kind of, I guess, chop sideways for a while. So that's how I sort of see the interplay between those two groups. But again, I think they can coexist. I think that the pie overall is growing, especially given the mainstream money, the institutional money, the advisor money, and things like that will start to flow into crypto now that it's got that sort of institutional stamp of approval. So, we can all grow.
Yeah, that's a good way to put it, too. There's a lot going for crypto right now. A lot of good news has come out recently, but hey, there is still the gold bug community that loves to hate on crypto. Fact of the matter is, as you said, crypto looks like it's going to be around for a while, so better off just accept it and embrace it rather than fight it. But look, this translates over to a lot of other sectors at all-time highs. The broad averages, S&P, NASDAQ, those are at all-time highs, and that's even without the Magnificent Seven simply carrying the torch here. So this whole environment that we are seeing seems very much like a broad-based, more risk-on rally. What's your takeaway from this environment where we have gold, Bitcoin, and the broad averages at all-time highs?
This has always been a market that if it didn't broaden out, I should say, we're going to ultimately have a problem, right? You can't just have a handful of stocks running and nobody else participating forever and ever. It's interesting this year, you've seen the Mag 7 sort of thin out. Tesla's dropped behind. Apple just broke down. Some of the Mag 7 names have faded, but what's happened? The overall averages have held up. And, in the last 3 months or so, the returns on the IWM are about equal to the returns on the XLK. In other words, small caps and tech over about a 90-day period are roughly in line. Tech's beating it by a percentage point or two. And what does that tell you? Especially as you see, financials, you see transport, you see some of these other groups, industrials. Industrials are one of the sort of hidden gems over the last few months here that have done very well. So you add it all up and you say, look, this is a market, and some of the experts, I will say too, some of the technicians like Ralph Akampora and Craig Johnson that we had at the Las Vegas Money Show and some of the others I've spoke to, Craig actually said this is going to be a market where it goes from Mag 7 to Lag 7, but the overall averages and other groups make up for it. So I tend to agree with that. I think one of the big stories this year is going to be broadening, better breadth and so on, and people making money in other sectors. I don't think tech crashes or anything. I think it might just kind of get left behind and chop around while these other sectors pick up that torch. So again, I don't want to sound Pollyanna-ish, but a lot of the things that I started to see almost a year and a half ago or more than a year ago align for a bullish outlook haven't sort of disappeared or got, reversed. It's gotten better. So I think in that scenario, you can always come up for excuses to sell stocks or not own them or not buy or whatever. But I think you got to look at it from a sort of a clear-headed way as possible and say, look, there's things that really argue for a strong year, a great year. Keith Fitzgerald at our event actually said he thinks this could be a year for the record books. I don't know that I'd go that far, but, I got a lot of reasons to be optimistic here.
Well, Mike, since you do talk to so many people at the Money Show and you get such a range of ideas and input from experts there, are there any sectors under the surface, like you mentioned, the small caps doing better, or even industrials were doing better in a stealth rally? Are there any other segments of the market that you heard about or that people have flagged that could be a contrarian place to keep riding up some strength that are being overlooked right now?
Well, again, here's financials, right? I mean, you've heard probably the news that New York Community Bank, another one of these super regionals or regionals that got in trouble with commercial real estate lending and the stocks tanking and so on. But unlike when you had those banks out in California and otherwise out west that were tanking and failing, guess what the XLF, the financial ETF's done? In the last 90 days, it's up 13%. Okay, is 13% up as much as the AI stocks? No, it's not. But it's that kind of stuff. You look at industrials, 13.5%. I mean, these are respectable runs, and not only are they respectable runs, they're ones where these sectors aren't giving back much, even when tech, stumbles and so on. So I think things that align with a soft landing to even potentially a reaccelerating type economy later in the year and as we roll into 2025, those are the kinds of things that I think look really strong. I think that have great prospects. So from a market cap standpoint, it would be small over large. From a sector, it might be transports, industrials, and financials over just big tech. So those are some of the areas that I'm looking at, and I think probably are pretty attractive for this year.
Yeah, to your point, look at XLF. It's back pretty much at all-time highs, too. So this is an environment that, boy, oh boy, there's a lot of money coming into the system. To that point, though, let's look at something like the US dollar, which has been generally flat. And look, if the dollar moves down, money can rotate into markets. However, again, this dollar's been mostly range bound throughout 2023, 2024. How important is it for investors to watch the dollar in this more just generally bullish risk-on environment?
Sure. Well, when you and I used to talk months and months ago, I described the dollar as a governor on the engine for precious metals and other commodities. Basically, it's not the end all and be all that totally dominates what happens with metals and commodities. But it is something that if they have other bullish factors going for them, and that you'd like to think the engine could rev up, unfortunately, the rising dollar, and especially in 2022, the surging dollar acted as a governor. It kept the engine from revving. And obviously the dollar is down from its peak in 2022, but as you noted, it's been chopping sideways for a few quarters here. Just getting a sideways motion is now, essentially allowing gold to break out and silver and so on. So I think you don't need the dollar to crash to ignite or drive this next bull leg in gold. You just need it to basically get out of the way. And I think that's what we're seeing. So again, dollar downside would help commodities sort of, the opposite of the governor, maybe turbocharge the move a little bit. But I don't think you necessarily need that for another bull leg here. You just need it to get out of the way.
Well, Mike, talking about the dollar as a governor makes me think of the teeter-totter market we had for a couple of years where it was really a story about the dollar and interest rates. If the dollar and interest rates were up, everything was down. And if the dollar and interest rates were down, everything was up. Now some of those correlations have broken down, and even the dollar and interest rates are moving separately. So how are you looking at the bond market now and the interest rate market?
Yeah, I mean, again, I just think that when it comes to rates here, the Fed, even in testimony this week from Jay Powell, basically confirmed we're probably going to cut rates. That's our base case scenario. They did obviously push back on the idea it's going to happen at the March meeting or, earlier than that back in January. But I think that, the market's pretty convinced we're going to get a couple of rate cuts this year. And I think that that's right. I mean, I didn't look at the pricing yet today, but I mean, we went from pricing and I think it was about 6 rate cuts at the peak when people were most bullish on the idea of rate cuts. And now it's more like, 4-ish, depending on which day you're looking at the futures markets. And I think that's pretty consistent. Yeah. Like as we're talking, I mean, the funds market's looking for maybe, a most likely scenario of a 4% to 4.25% funds rate by this time next year. So, we're at that 5.25-ish range and, do the math. So I think that you can see that it's a market that's getting more comfortable with the idea that we're going to get cuts, and that gradual reduction as inflation gradually comes down, as some of the rent and housing impact that's been working the way the government does the numbers has been working to keep core inflation higher, despite the fact real-time rental indicators are moving lower. All that's going to work its way through the system, which leads to gradual declines in interest rates. And again, a nice bullish backdrop for assets like gold.
Can we take a look back here, Mike, in terms of any times in history where you have noticed a similar environment here where markets at all-time highs, precious metals at all-time highs, and overall it just seems like everything is quite bullish out there?
It's a unique environment. Yes, it is. And of course, in past whatever environments where you had a soft landing or whatever you want to call it, you didn't even have assets like Bitcoin that existed really. So I think every scenario is different. Every market's different. But and look, I'll admit I was wrong about the Fed. I thought they were going to give us a hard landing versus a soft. But if we're truly going to come in for that soft landing scenario, I mean, look, the market ripped in after the 94 and early 95 cycle was done. I think that's probably why some of the people like Keith are talking about maybe a year for the record books. And I think even, you're going to have pockets of where the markets get overextended and sentiment gets, exuberant, if not irrationally so. I mean, obviously stocks in the AI sector, for example, have been ripping. So sometimes that can get out of control or whatever. I don't necessarily think we're there now. But broadly speaking, I don't see excessive exuberance. I don't see, people, the shoe shine guy, giving stock tips. I don't see people bragging all over social media that how much money they're making, kind of like we had with the meme stock run up and crash. It seems like more of a healthy, broadening, fundamentally and technically supported move. And when you have all that going, why would you fight it? I just don't think it's the right time. I don't see anything imminent or even in the short to intermediate term that's going to change that dynamic. So, ride it is my advice. Be bold.
Well, Mike, in the spirit of being bold, I do want to at least give a small amount of airtime to people that have the bearish side of the argument. We've heard for years that we're going to have a recession that never came. We did have a pullback in 2022 in the markets of 20 to 30% in a lot of the indexes, but there's been people expecting a secular bear market in the general stock market that doesn't seem like it's anywhere close. There's people that have been looking for economic contraction when GDP keeps expanding. Has the recession officially been called off for good? Has the bear market in the equity markets been called off for good? Is there anything out there that the bears have to latch onto, or are we really setting up for, as you say, a year for the record books?
Look, I think we're seeing, the labor market, some of the data that's been out recently decelerate. So I think if deceleration turns into declining, that's going to be an issue. I think if we get big geopolitical surprises of some sort, that's always, kind of a black swan looming in the background. And let's hope for the world's sake and our sake, it doesn't happen. If you see the selling in the Mag 7 group, instead of it being a healthy rotation, turn into oh my gosh, get me out of these names, I'm losing too much money, and accelerates, that would be a negative. Those are some of the things that I guess if I had to say what are the most likely things that can derail this would. But again, that's not what I expect. That's what it's certainly able to watch for. I guess the other thing I would throw out is, there's going to be difficulty in parts of the banking and credit markets. I mean, the CRE, commercial real estate issues, loan losses, buildings losing value. I mean, that's real. That's happening. But unlike the 07 to 09 cycle in housing, the way these loans are made, the way the market's functioning, it's more of sort of a slow burn in the background where certain institutions have issues, certain people lose money, but you don't have the forced liquidation selling that brings down the financial system because the structure of all the lending and securities that are not like they were back in that time. So, if I turn out to be wrong there, fine. You get some credit worries that spread, and instead of having a handful of banks that overdid themselves and a handful of private investors that overdid themselves, lose money in real estate, I suppose you could see a banking crisis develop out of that. But again, that's not what I expect. I mean, I've been following the financial and banking markets, lending markets for a quarter century now, and it just seems like a different animal. And I certainly, as opposed to in the mid-2000s when I said, no, don't listen to that well-contained garbage. This is going to be a disaster.
All right. Enough said, Mike. Great chatting with you. Thank you very much for taking us through your thoughts on the markets. Again, Mike is the editor-in-chief at MoneyShow. I will post a link to the company's website so you can find out about the upcoming conferences that the Money Show puts on. Mike, great chatting with you this weekend. Have a great rest of your weekend.
Thanks, guys. You too.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. Providing unique reporting on markets and companies since 1990. This is the Corlin Economics Report.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report, and we are continuing to bring on more of our generalist guests here to comment on a lot of all-time highs that we continue to see in a wide range of markets. We are now chatting with Dana Lyons, fund manager based out of Chicago. You can follow along with Dana at the Lyons Share Pro website, which I will link to within our website and podcast post. Dana, you know how much our audience likes the precious metals market, so let's start off with gold and the rally that really started last Friday and has continued through this week. As we're recording this, about halfway through the day on Thursday, gold is trading about 2165. It has continued to extend. The first time really ever that we have seen, or at least in the last decade, where we have seen gold reach up to about 2100 and keep on moving, not reverse right away. I know you have been playing GLD and thinking that a breakout could happen. Now that it's here, what does it look like for you?
Yeah, thanks, Corey. Yeah, it seems like we've been waiting for a breakout for years because we have. But I think that, as we've talked about, that basically the last 4 years of consolidation has really allowed gold to store up some potential energy or momentum for a more of a sustained breakout. So instead of the breakouts that sometimes we see that end up being fake outs because they don't have that potential buying power behind it to sustain the breakout. I think this one certainly does after consolidating for 4 years. So like we've been talking about for months, I think there could be a lot more to the upside, specifically in GLD, to this breakout. I guess a couple, I don't like to put targets on it, but I would say a couple obvious extension points or targets to the upside in GLD, which is trading, I guess, around 199 right now, just below 200. But we'd be looking just over 220 and then around that 240 area for, the first kind of destinations maybe for this breakout, for this new up leg. So definitely plenty of room to go to the upside as far as we're concerned.
Well, Danny, when you look at the gold equities, they are a different entity than the metal itself. But how are you looking at the setup in the gold stocks?
Yeah, definitely. They've been obviously more frustrating because they haven't really participated, been more sideways for many years at best, and even recently as gold has consolidated near the highs. The miners have been pulled back really near, multi-year lows. But as I mentioned in the last couple of shows, we've been holding miner exposure for a little bit now, more almost as like a call option. We think once gold does break out, that should lift the equity space as well. And we're seeing that, over the last week or two. We're seeing the miners start moving now. The problem is on the charts, they got plenty of resistance to try to fight through. But if gold sustains this breakout and moves higher, obviously that should really lift the miner space. And you talk about kind of an unloved space. You could really see an acceleration in the upside if money does start chasing into that space. So right now, I think we're at one of those resistance levels, kind of the middle of the range that it's been in lately, whether it's GDX, GDXJ, even the silver miners. So hitting some resistance right now, if we can break through, that would be the first probably technical victory for the miner space and would open up more upside, certainly in the near term.
So Dana, for somebody looking at, again, the gold stocks that have just underperformed so much, and say people have been out there trying to pick bottoms, and unfortunately, as you said, they recently traded some multi-year lows, at least some of the individual stocks, but we have seen some life. I've noticed a lot of even small cap stocks in the gold sector bounce up 20, 30% in the last couple days, but there's still a lot of room to the upside. What do you look for on a chart that confirms that momentum and more money are coming into a sector that has been beat up quite a bit and has so much upside, but has disappointed so many times?
Yeah, well, I mean, just some obvious things you want to see. Obviously, some the technical levels, technical resistance broken. You want to see the trends broken. You want to see some volume really come into it on the upside. Of typically, we don't watch volume a whole lot just because it's very predictable. You always see the most volume, on the downside and especially at lows. But if we can get a rally going here in the miners and see like a sustained amount of above average volume flowing into the miners, I think that would be a great sign that maybe some sustainable money flows are coming into it. but just simple things like trend breaks and resistance overtaken and a good volume would be certainly good signs for that space.
Just one more quick follow-up on the overall precious metal sector, Dana. We've had a couple people write in asking, okay, it looks like things are breaking out, but how far could this actually go? Are we going to have the football pulled away from Charlie Brown like we have so many times and just fall flat on our face? You mentioned how long it took to actually break out, how long the basing period was. When you look at a market like this that's been stuck sideways for a long time or bumping its head up against resistance, do you have any models for how long something like this does tend to play out?
Like I was mentioning, the longer something does base or, as you said, or consolidate and hold up near the highs, the more energy and more sustainable the advance can be. So something, we saw that rally from, I think, around the 2018 low into the COVID top, where we saw gold slightly break out to, or at least GLD slightly break out to all-time highs. But that was after running for about 2 years straight. So that type of a breakout tends to fail. It's not sustainable. You don't have that further, buying power or money on the sideline, so to speak, ready to come in there and sustain that bid. So those tend to fail. But like you mentioned, now that we've been moving sideways for basically the last 4 years or so, you've got a lot more fuel, a lot more potential buying demand for a breakout that can sustain that breakout and continue to move it higher. So there are general rules that, the bigger the base, the higher the space, or whatever the sayings are. So based on that theory, after moving sideways for about 4 years, maybe you got 4 years of upside. I don't like to, put that strict target or guideline on it, but certainly on you could sustain this thing for certainly years. I mentioned how much upside we have, even right off the bat. I think you've got that type of fuel, that type of potential energy to sustain that breakout after, consolidating for 4 years.
All right, Dana, let's also look at U.S. equity markets because, as I said on the onset, there's a lot of all-time highs that we can talk about. U.S. equity markets have been hitting all-time highs on a very consistent basis. What are your thoughts on the sustainability and even the potential of these markets to just continue to extend on these gains?
Yeah, so if we parse out the different durations, I think on a long-term basis, we're much closer to the end than the beginning of any sort of a bull market. You look at all the what we call background indicators like valuations, how much households have invested in the equity market, much closer to the end. But if you look at what we call an intermediate term basis, which is the measure of months, our intermediate term models typically give signals like 2 to 6 months or a little bit longer. And on that basis, I think we've got more to run to the upside. Certainly, you mentioned that we've been hitting new highs for many years now. If you really look at it, most of the broad market topped out around the beginning of 2022. So we've really gone nowhere for a couple years until we just broke out earlier this year, or I think towards the end of the last year, maybe in the tech space. So from that perspective, we're towards the beginning of this intermediate term breakout. Obviously, we've run a lot. We are extended in the near term in some of those large cap averages. So I wouldn't suggest that we chase every tick higher here in the large cap space. But I would say after moving sideways kind of for 2 years, I would expect there would be much more upside here in the intermediate term, and especially looking in the broad market. We talked about a little bit before I came on. You look at something like the New York Stock Exchange advanced decline line. Historically speaking, I mean, since they started these records, the advanced decline line has always diverged at major tops, cyclical tops. So you see a new high in the S&P 500 that isn't confirmed by the advanced decline line. And I know a lot of people have been talking about that over the last several months as the S&P has made new highs. And the AD line did not. Well, a couple days ago, the AD line did finally confirm that new high. So that kind of resets the clock in terms of expecting a top. So that pushes the top out further. How much further? I don't know. The divergences have lasted from, a couple months to a couple years historically, but I would say certainly it extends the time, and I would say there's significant more upside potential, especially given that new confirmation, the AD line.
Well, Dana, with the internals improving in the market, and as you say, the market breadth broadening out a little bit, there are some other sectors besides tech that are starting to rear their heads and show some relative strength. What other sectors of the market have your attention right now?
Kind of the breadth of constructive or relative strength sectors has kept us positive on this market. In addition to our models, there have been many more sectors and market segments that have been constructive and that have been in positive postures on the charts than negative, and that's kept us bullish. At this point, like I mentioned, especially in the large cap and the tech space, while still constructive, they are a bit extended depending on which areas you look at. So we're always looking for kind of new relative strength areas that haven't run as much, that are not extended, that are maybe just starting, that the type of a run that large cap and tech has shown over the last 4 or 5 months. And one area in particular, I guess, right now would be healthcare, which has kind of been in the doldrums for the last year. We've seen over the last couple of weeks or days even, a lot of areas in the healthcare space just break out to new highs, including several funds in the biotech space, which just broke out. So those types of kind of new relative strength, I would call it, are the areas that we'd be looking for adding exposure, especially if we're removing some exposure in other areas that are extended and hitting maybe some key extension levels. We want to take some profits in those areas. There are other spaces like biotech, like healthcare, that we can roll that money into that probably shows more potential in the intermediate term now.
Dana, what about the balance between value and growth sectors? Which ones do you see outperforming, and what does it tell you about the overall attitude of investors?
Yeah, well, the good thing is you've got good performers in both. I think we're, in maybe the transition in the longer term from growth outperforming, which it has for decades, to value outperforming. But it's not like it's signaling that we need to get out of growth entirely and pour into value right now, because you've got a lot of the growth space obviously still performing. So we don't want to jump ship when things are still going smoothly there. So the good thing, like I mentioned, you've got areas on both sides of the fence. So you can have kind of like a barbell type of approach there, which from a diversification standpoint is appealing as a manager. We've often said, we concentrate on relative strength and concentrate our portfolios in those relative strength in those areas that are performing best. And sometimes it's very limited, but when it is limited, we don't want to diversify just for the sake of diversification when some areas of the market are going to drag our portfolio down. But when we do have a wide array of areas that are performing well, including growth and value, then we're happy to diversify because we've got a little bit more cushion on certain days. We've seen, even this week, we've seen days where one area of the market's been good, the other one's gotten whacked. A couple of days ago, the tech got beaten up, but really the overall breadth wasn't that bad. And we had a lot of our position were actually up on the day, even though, the NASDAQ was down 300 points or whatever. So it's good to diversify when a lot of areas of the market are performing well, and I think that's what's going on right now.
Well, Dana, another segment of the market a lot of people are watching due to the changes in interest rates and Fed expectations is the financial sector. If you look at something like the XLF, the financial ETF, it's been scorching higher. But if you look at things like the KRE, the regional bank ETF, still not gotten out of the muckets. And you've mentioned some strength in insurance and some other areas of the financial sector. How are you looking at the financials?
Yeah, I mean, the financials is another area that have been performing well. Hey, I mentioned this before we came on as well. I think lately, if you've thrown a dart, at the market, you've had much better chance of hitting, a constructive looking chart than the negative one. So that's been good, including financials, which have been performing well. We've got the XLF, like you mentioned, approaching all-time highs that we saw at the start of 2022. So we might have some sort of a consolidation or pause there, which would not be unhealthy or surprising. But as you mentioned, insurance, there's some other areas in the quasi financial realm that have been screaming higher. So we want to pick out those areas within a certain sector like insurance that have been moving higher and kind of stay away from those areas that might have micro issues going on with them, like the regional banks. So again, speaking to that diversification point, we don't want to be diversified just for the sake of diversification. We want to concentrate in those areas that are acting well. And if there are a wide array of areas that are performing well, then we're happy to spread the wealth around.
Let's talk about another area that is performing quite well, and that is Bitcoin. Bitcoin, as we're talking, right around 68,000, continues to be volatile, which I think a lot of the traders like about it. Fact of the matter is, it's also back at all-time highs, and it has just taken off in the last couple weeks. Dana, what's your outlook for Bitcoin then?
That's one, speaking of the XLF, where we've got Bitcoin running right up to the former highs. So it would not be unhealthy or surprising to see some sort of a consolidation here or a pause in the run. It would be actually healthier if it did pause for a bit, at least temporarily, before attempting a breakout and a new run higher. Although I wouldn't put anything past this space. It can be a little bit goofy, but technically speaking, it trades very much according to, kind of textbook technical concepts. So I would love to see it consolidate here temporarily, pull back maybe towards that recent breakout area around, the lower 50,000s level, perhaps, and add some further exposure. But I would say the momentum that we've seen, given the recent run, would suggest that it's got more upside potential to it. So again, I'd love to see consolidation and take advantage of that to add exposure for a breakout and a new pop higher. I would say, just from a charting standpoint, if you're looking how much upside might be there on the next run, coincidentally looking just at a regular Fibonacci extension of the bear market we saw from the 2001 top, the next key level would be right up around 100,000. So good round numbers often come into play in markets, and that might be something that we see later this year.
Well, Dana, we've talked about two international currencies with gold and Bitcoin and the cryptos, but what about the international markets? I know you sometimes use ETFs to play different countries where you see trends unfolding. Anything catching your eyes internationally?
Yeah, there's a lot working internationally, which is again speaks to the breadth of performance in the markets, not just domestically but globally. Japan has been on fire for a long time now. We're seeing the Nikkei, another one that's testing all-time highs. That could see a bit of a cool down here or consolidation before that tries to break out. Obviously, it's been I guess 34 years in the making, coming back and testing that former high. But I think you're seeing a good breadth of international markets that have been performing well, including other emerging markets like India, and then also developed markets like in Europe. I know Europe's got plenty of issues economically, fundamentally speaking, but just from a pure charting standpoint, the European equity markets have been performing well. Even just broad, if you want to just take some broad international position, look at the EFA or the global Dow index, you're seeing a lot of good performance there. Some areas that maybe just emerging. We're looking at, we just added a couple weeks ago a position in Canada, which is maybe just getting started, similar to like the biotech chart that I spoke about earlier. maybe just breaking out now, so it's not as extended as some of these other areas. So if you're looking for something to allocate new money to, that's one potential area that you can move into.
Dana, I've been asking everybody this week in terms of historical references. When we're seeing markets at all-time highs, international markets doing well, and even these kind of safe haven assets like gold, maybe if you want to consider Bitcoin that too, those also reaching all-time highs. Can you think of any other times in the past, in history, where this has been the environment?
Across asset classes, I'm not sure. I'm sure there have been. Just speaking to the breadth of the equity market alone, I would say it speaks to the strength and maybe the durability here in the intermediate term of the upside potential there, just because you have much more of a cushion. You think about when market tops have narrowed in the past, just from a short-term perspective. Look at last July when there were only a few stocks moving higher. When you have that, it's easier for markets to top out. All you have to do is have a couple breakdowns in those stocks that are still moving higher, and you can take the market down. At this point, you've got a bigger cushion because you have so many areas of the market that are performing right now that, you knock a couple off. We had some tech issues a couple of days ago in tech land, but you saw how easily the market absorbed that and right back to new highs. So that breadth of performance really provides the foundation where it cushions any blows like that. And I guess that's maybe why those divergences in the advanced decline line typically occur before those tops and the major averages occur, because you've got to kind of chip away at that foundation before it's vulnerable enough to put in a major top. So I guess that's why one of the reasons why we're still very constructive here on the equity market in the intermediate term.
All right, Dana, thank you so much for taking time with us. I always appreciate how you're playing these markets and the individual sectors that you see opportunity in right now. Man, oh man, it's a good time for investors. I know that makes some people feel a little uneasy because it seems almost too easy out there, but you just outlined some sectors that could continue to run, and as you said, in the intermediate term. Again, you want to follow along with Dana, go visit the Lyons Share Pro website and check back in with us because we chat with Dana pretty much every 2 weeks. Dana, thanks for joining us on this weekend show. Everyone, thanks for tuning in to this weekend show. Be sure to visit our website, kereport.com, and podcast the KE Report to listen to all our daily editorials and company updates. I hope you all have a great rest of your weekend.